I didn't hear.
You think is there going to be a drastic change anytime
Oh,
soon? I don't think.
well, we're figuring there's going to be a change. The extent of it and when it's going to be effective, that's still a question mark. I feel like the exemption's definitely going to change. It'll probably take into effect next year. But as far as like other parts that affect estate planning, like grantor trusts, valuation discounts, that might become effective this year. So there might be a mismatch in some of the aspects of the planning that we usually implement. So there's a lot of question marks as especially with the grantor trust as to whether grantor trust will be grandfathered. Grantor trust established now will be grandfathered into the new law. There's just a lot of uncertainty out there.
So, okay, are you going to control the screen, or I'll just control the screen as I present your PowerPoint? You have very short PowerPoint anyway.
Right. Yeah, I thought I'd just
Okay.
speak briefly about asset protection trust and
Right. So, all right. I think at this point, I would like to start the recording. Everybody's already in the mute. Okay, let me see. Yep. So if anybody comes late, that might be a little bit of distraction, but okay. Let's see if we can mute them.
I think it's recording.
They are recording.
I think so.
Record in the computer.
Maybe.
All right.
I think we're recording.
It's recording. Yeah.
Well, thank you, everyone. Thanks for joining us in this afternoon's meeting. It's a private meeting, and we're going to tackle about trust and some basic estate planning. That includes a little bit of discussion in the wills, and you can feel free to ask our attorneys here right now. Take advantage. It's a very short 1 hour meeting, so if you need a separate meeting with them, just let me know. We're gonna reach out and try to make a schedule for you. At any rate, I'd like to start with a colleague here from the New York State Society of CPAs, Albert Tumawal. He's an associate attorney in Robinsons-Briggs Trust and Estates and Tax Departments. His practice involves structuring and implementing sophisticated estate planning strategies focused on maximizing the utilization of the estate, gift, and generation skipping transfer tax exemptions, as well as business succession and asset protection planning. He also represents clients and matters before the Internal Revenue Service and the New York State Department of Taxation and Finance. Albert has been selected every year since 2017 in the Super Lawyers New York Metro Rising Stars list. He holds an LLM in taxation from NYU School of Law and from Touro College. Denise from Touro. All right, and we're here in cum laude actually. So friends, it's my distinct pleasure and it's an honor to introduce to you Albert.
Thank you, Carol, for that kind introduction. And my focus on my slides here will be on using irrevocable trust as a tool for asset protection. But first, I wanted to just go over the basic structure of an irrevocable trust. If we see here on this first slide, I can go back two slides. Not quite sure how to do that here.
Okay, the first slide isn't about domestic asset protection trust.
All right, so if we can go to that first slide that's titled General Trust Structure, is that available?
Oh no, I'm actually wondering about that because the slides start here.
Oh, okay. Well, okay, so that's fine. I'll just it was basically a diagram showing the structure of a basic irrevocable trust.
Oh, you know what? I think I'm sorry about that. Let me pick up where let's go to actually your main PowerPoint. You're right about that. Okay, sorry about that. Yeah,
No problem.
there. Oh, it's still not showing, right?
Right.
Ah, okay.
That's okay.
For a while. And let me hit from the beginning. I don't know why, but okay, now we're doing.
Okay. All right. All right. So there we go. Perfect. All right. So we see here, this is the general structure of a basic irrevocable trust where a person called a grantor creates a trust by transferring legal title to property to a trustee who holds and manages that property for the benefit of a beneficiary. And the beneficiary holds equitable title, which entitles the beneficiary to the enjoyment of the property, but usually not the ability to transfer the property. And in New York, the general degree of that beneficiary's enjoyment and right to trust property will usually determine how much protection the trust assets have from that beneficiary's creditors. For instance, a beneficiary can have mandatory income rights, or it can, have rights to periodic distributions of the trust principal, which is the initial property transfer to the trust. If the enjoyment of the trust assets is subject to the trustee's complete and absolute discretion, meaning that the trustee solely determines whether or not to make distributions of income and principal to beneficiaries, the amount of the distributions, the timing of the distributions, and which beneficiaries can receive those distributions. Well, the law is pretty clear that in that case, if the grantor and the beneficiary are different people, then the trust assets will be fully protected from the beneficiary's creditors and the grantor's creditors. But what if the beneficiary was the grantor? Well, in New York, that's called a self-settled trust. In the next slide, it's the same diagram, but it describes a self-settled trust where the grantor is also the beneficiary, and trustee can make distributions to the grantor in such case. Well, the law is pretty clear in that case too, that the trust will not be protected from the beneficiary's creditors or the grantor's creditors because they're the same people. However, and this is where we get to the bulk of my presentation here on the next slide, there are 19 states that are called asset protection states. The most popular being Nevada, Delaware, Alaska, and South Dakota. And in these states, they will allow a self-settled trust and grant and give the grantor asset protection. So if you have what I described before as a fully discretionary trust, where the trustee has complete discretion over the trust property and can make distributions to the grantor, well then that trust, the trust assets, are going to be fully protected from the grantor's creditors. So that means that you could create a trust in a state like Nevada and be the beneficiary of that trust and retaining access to whatever property you transfer to the trust and still receive asset protection. And as another benefit, these states also allow what's called directed trusts, which generally means that these trusts can have special function trustees, usually an administrative trustee who establishes the residence of the trust in the asset protection state, an investment trustee, and a benefits trustee. And the investment trustee controls the investments of the trust assets, and that can be the grantor. So the grantor can retain the beneficial enjoyment of the property that they transfer to the trust, and they can retain the investment control and still and still have asset protection, still protect those assets from their creditors.
So can he trustee?
What the grantor can be the investment trustee, and these trusts, they separate each. You couldn't do this in New York, but in a state like Nevada, you could separate the fiduciary duties of each trustee. So if you limit the grantor's fiduciary duties to strictly the investment, then that's okay for asset protection. The grantor couldn't be the benefits trustee because that would create what's called a general power of appointment in the grantor, and generally a creditor can attach to property over which the grantor has a general power of appointment. So that's why you would need a benefits trustee, but a benefits trustee can be anyone. It doesn't have to be a resident of Nevada. It could be a trusted third party, or it could be the grantor's spouse. So that's the main advantage of these trusts established in these asset protection states. And the reason why I go to Nevada so often is because, one, my firm has relationships with trust companies in Nevada, and two, the statute of limitations on fraudulent conveyances is 2 years. A fraudulent conveyance claim is a claim that a creditor can use to unwind the transfer to the trust and attach their claims to the trust assets. Generally, in states like Delaware and Alaska, you have to wait 4 years into those claims, until claims like that can lapse if they're not brought up front. In Nevada and South Dakota, it's 2 years. And the main reason why we select Nevada so often is just that there's just more of a selection of institutional trustees in Nevada than in South Dakota. So as far as the requirements, as what these trusts require, they usually require, like I said, a trustee who's a resident of the state, and that's usually a trust company in the asset protection state. The trust must be irrevocable, and the trust must have a spendthrift provision. The spendthrift provision prevents the beneficiary from being able to transfer or assign any interest in the property. So that's the basic structure of a domestic asset protection trust, and that's really any trust that's established in any asset protection state. There are other. Yeah.
I have a question. Is there the spendthrift provision if, let's say, it passes on to, let's say, it's one of the adult children as a trustee? Is it possible that they could later decide to sell some part of the assets?
What they could sell the assets, and that would be under the purview of an investment trustee. They could sell the assets within the trust. As far as distributing out the proceeds, that would be up to the benefits trustee, and whether that's permissible under the trust.
Okay.
So usually the grantor is a beneficiary, and the grantor and you have another third party as the benefits trustee. They can make that distribution out to the grantor.
And after the death of the grantor, is there a room for a change if the other beneficiaries, like the second generation, let's say the children or the grandchildren, is there room to change any of that and do some kind of distribution of assets?
Well, that could be built into the trust document itself, but another key benefit of these trusts is that they have more relaxed rules as far as amending irrevocable trusts. Even after the death of the grantor, usually you could not amend an irrevocable trust after the death of a grantor, especially without going to court, especially in New York. In these states, they usually have, you could usually amend the trust through agreement of the beneficiaries and the trustees. And another key key benefit of these trusts is you can add what's called a trust protector. Now, the trust protector is not necessarily another trustee. It could be. It depends on the duties of that person, and that trust protector could be given the power to change beneficiaries, to change trustees, and even to amend the trust.
Oh, okay. So do you need the next slide?
Sure. Yeah. So I just wanted to go. So the other benefits, in addition to asset protection for these trusts, general estate planning. It could replace a revocable trust or a will and pass assets to your descendants without the need to go to court to probate a will. These trusts we often use for estate planning, especially in today's environment, where we have, especially for people with estates up to about 15 million, where clients don't necessarily, they're subject to the estate tax, but they don't necessarily want to part with control and access to the assets. So we usually recommend using these types of trusts. Just want to also say that there's also going to be an annual fee for these trusts, because you have to pay a trust company in Nevada or Delaware to administer the trust. But for a lot of clients who are trying to use up their enhanced, what's called their enhanced exemption, that usually doesn't present too much of a problem. In addition, these trusts don't have to be used for estate planning. They could be used as a tool to avoid state income tax. In New York, any trust established by a New York resident is going to be a resident trust, or New York resident trust, but that trust might not be subject to New York tax if certain conditions are met. If the grantor is a beneficiary, there has to be an adverse party, usually another beneficiary, who has to consent to any distributions to the grantor. And then the trustees that I just mentioned, the administrative trustee, the benefits trustee, and the investment trustee, even the trust protector is acting in a fiduciary capacity, cannot be a New York resident, and assets, there must not be any income from New York sources. And usually if you have a resident who's not a New York resident and owns stock, let's say, capital gains are not going to be considered New York source assets. And if you meet those requirements, the income from the trust is going to avoid New York state income tax. However, there is a clawback for accumulated distributions of accumulated income for distributions to New York residents. But at that point, you can have the beneficiary consider moving to a state like Connecticut or New Jersey, so that way they can receive distributions from the trust free of New York taxes.
Okay.
So that's my story, and I'm sticking to it.
All right. So let me take you out of the share so we can see. All right. If you have any question, go ahead. You can unmute yourself. Now I have a question. And Albert, you mentioned that actually you can also create a New York trust as a New York resident, subject to certain conditions, right? Can you repeat those conditions that you said so that it would not be taxable?
So the trust would have to be established outside of New York. So, for instance, let's take what's usually called a NING, and that's short. That's NING. That was a popular technique used in the past for avoiding New York income tax. That's short for a Nevada incomplete non-grantor trust. And New York passed a law in 2014 that kind of cut out one of those requirements. So what that trust was, that was an incomplete trust that allow the grantor to more control over getting access back into the trust. So now, after that New York law, the trust has to be a completed gift. So that limits the rights of the grantor. So the grantor can still be a beneficiary of the trust, but it would need an adverse party to in order for distributions to be made to the grantor. So that's
So
that's
I'm sorry,
So,
who's the adverse party?
so an adverse party. Let's say you have a trust, and that permits the trustee to make discretionary distributions to the grantor and the grantor's descendants. So in that case, you would put in a provision saying that, notwithstanding the foregoing, distributions to the grantor cannot be made without the consent of the grantor's daughter. Let's say that would be the grantor's daughter would be an adverse party, and that you would still have a completed gift trust there, but that provision would prevent the grantor from being taxed on the income from the trust, especially if the grantor is a New York resident. That's what we're talking about. So the other conditions are that the trustees, none of the trustees can be New York residents. The income from the trust and the income from the trust cannot be from New York sources. So, for instance, if you have a building in New York, if the trust owns a building in New York, and it receives rental income, that's going to be subject to New York income tax. I mean, there are other nuances. You could tailor the trust down even further to split up into separate trusts to own different types of properties to specifically isolate the New York source income. But generally speaking, if you have New York source income, it's going to be subject to New York State income tax.
All right. Well, we're thinking of questions to ask. I'm gonna bring in our next speaker, and just hold on there. Just you're not in a hurry, Albert. You could just stay.
Oh, yeah, I could stay. I do have a hard stop at 2:00. I have a call at 2 o'clock, but I could stay for up until that time.
All right, sounds good. So, right now, let me bring you Steve Morris. Are you sharing already your screen, Steve?
Yes, ma'am. Can you see it?
Yeah, maybe you can exit for a while, so I could give them a little bit of background. All right.
Okay.
Okay. Yeah. So there you go. I want everybody to see Steve. Hold on. And wait, we have to exit also the other arrangement. Okay. Let me just bring up. Sorry. Okay. So while thinking of other questions, and I'm sure after you hear Steve, you might have a lot more questions. And I'm having Albert on a standby, so both of them can respond to your questions. But meantime, Steve is the managing partner of Intervention Point. And talking of the Nevada Trust, here goes. Steve Morris has held senior leadership positions in the Advanced Telecommunications and Metro International newspapers, including Los Angeles Daily News, New York Daily News, and has been a consulting of 8 years ago, and found a big gap in the service for the mass affluent clients, so that his firm now is focused on handling Nevada Trust and South Dakota. So the law office of Torrey D. Allen assists clients with many legal matters, specifically in the areas of estate planning, trust, and even wills and immigration. But today we're focused more on our trust. So Steve, yeah, I think you could share that part of the intervention point. Okay.
Okay. Can you see the screen now, Carol?
Yes, we can.
Okay, it's a pleasure to be talking to all of you, and I really appreciate what Albert talked about in a very specific way. Mine's going to be a little more general because you're a pretty sophisticated group of folks who know Albert and Carol, and many of you CPAs. So this might be a little more basic, but I think it might be very, very helpful in understanding how trust can serve you, especially in Nevada and South Dakota. First of all, here's what families worry about when they're thinking about trust. They worry that they're going to lose control of their assets. They want to make sure, especially as they get older, that they're in charge, that they're not locked away and they can't get a hold of them. They worry if they've got a special needs family member that possibly would lose their state disability payments if they got a big lump sum payment from a trust or a passed away parent. They worry about long-term care costs and the fact that Medicare can take your home, Medicaid can take your home. And they worry about the costly delays of probate. All of us know somebody whose family went through probate court, cost a lot of money, and created a lot of challenges for the family. And then they get afraid that divorce would take half of a legacy. If a lump sum went to a family member and 40% of them are going to get divorced, the ex-spouse could take half of it. But most of all, people want their families to know they care. So we structure documents for your family, and we use lawyers in Nevada and South Dakota to review them to make sure that your family knows you care. So, how do you benefit? Well, as Albert laid out, trusts avoid lump sum distribution to heirs, thereby protecting those assets from the devastating cost of future lawsuits, divorce, reckless spending, or long-term care costs. We had a client the other day who had a friend whose daughter got $1 million lump sum payment. She spent it all in 10 months. It's all gone. Well, now her life is ruined and she has no safety net. No one wants that to happen to a family member. We have special sub-trusts that many people add on, like the Special Needs Trust, Charitable Sub-Trust, Charitable Remainder Trust, or the protection of assets from long-term care costs, and also the Asset Protection Trust that Albert talked about. We're doing a lot of those. Everything is available to be managed by you through the client with the help of our client management services team. You get the peace of mind knowing your assets are generating the greatest positive result for your families at all times. And you save up to 48% on the standard cost of trust, as I'll show you in a minute. The first question we get from clients when we talk to them is, what's the difference between a will and a trust? Well, with a will, as you know, here's an $800,000 estate, because we do estates from $500,000 up to about $12 million. The folks above that have lots of lawyers and accountants that keep them protected, but the folks between $500,000 and 10 million don't realize they can take advantage of many of the laws that were created by those super wealthy. So we're here to make sure that you know about that. So a will is public. It's going to go to probate court, and creditors and predators are going to come forward. A trust is private. The trust company settles the estate for you and keeps it out of the news. And also make sure that they follow your control issues, not a probate judge. So you're in control of a trust. The settlement time on a will can be a couple of years. In fact, we talked to some folks in Georgia recently, up to 5 years. With a trust, it's usually 1 to 6 months, and the trust company takes care of it. The settlement cost for a will for an estate of just $800,000 can be 1 to 5% of the estate, or $16,000 to $30,000 easily. We have, because we do such volume in Nevada, we've been able to contract for much lower trust company costs, and the settlement can be $5,000 to $8,000 on an $800,000 trust. So that means a 1-year payout on a will would, on this side as a trust, would be about $780,000. With a trust, $792,000. But most people will extend it for 10, 20, 50, 100 years. And as a result, the trust grows. And I'll show you in a model of that in a minute. Now, as Albert mentioned, there's new taxes coming down. Can you escape these new taxes? the federal estate tax threshold is probably going to be lowered from 11 million to 3.5 million. They also are looking to end the step-up basis of debt. What that means is if you got a piece of real estate you bought for 200,000 and now it's worth $1 million, when you died before in your estate, that was valued at $1 million and there was no capital gains assessed to your estate or to your heirs. That may change with the new laws. And that's big. And plus they're increasing the capital gains tax, because that's their plans. So what are the solutions? As Albert says, use a no-tax state like Nevada. Use this year's threshold of 11 million per person or 22 million for a couple to create an asset protection trust. And by the way, you better do it before October because everybody's going to be very busy in the last quarter jamming all these in. Put high capital gains risk assets in a charitable remainder trust. I'll show you that in a minute. And put your real estate, because remember Albert said if you've got New York real estate generating revenue, you ought to put that in an LLC. So you don't own real estate in New York, you own an LLC that owns real estate. That might be a way around that. Now, why does everybody like Nevada? Well, obviously there's no state tax, but there's two other really big reasons. One is they're a very big innovator in trust law that favors you, the creator of the trust. But laws are one thing. What's really important too is the courts. Do they back the laws up? Nevada has the most favorable courts for creators in the country, whereas a lot of states that have new trust law changes, they're going to favor lawyers who challenge trusts. You want to be in a state where there's an evidence and case law that shows that the trusts are protected. Now, what is it that we do in a complete trust portfolio? Most of our clients are satisfied 85% with our standard portfolio for $2,000. And here's what that includes. It includes the healthcare power of attorney, which is a healthcare proxy or do not resuscitate or advanced medical directives, whatever you want to call it. It's what the hospital accesses to find out what you're allergic to. Do you want tube feeding or you're an organ donor? And who's going to make decisions for you at the end of life? We also do financial powers of attorney. And that's when you're incapacitated, you name someone in your family who's going to make sure that they pay the checks to keep your mortgage up, your utilities up, and that your state is financially solvent while you're still alive but not capable. It also includes a pour-over will. Now here's where you'll say, well, Steve, I thought a will was bad. Well, it is. The reason we include a pour-over will is because that catches any assets you left out of your trust and pours them over into the trust. It's a very simple will that goes to probate court and tells probate court, nothing to do here except pour these assets into this trust. Probate courts are very used to that. Then we do the revocable living trust. Very important. Revocable means you can change it throughout your life. You're in total control of your assets. And our revocable living trust is very robust. It includes a lot of items that many trusts would charge you extra to include, such as the marital ABC clause. Now, you may not know this, but when a couple, one of them passes away, if it's the woman that passes away first, the man will get remarried within 2 years, 61% of the time. He can't live without a wife. However, when a man dies, the woman will only get remarried 19% of the time. She's had it. So, what that means is, you know your husband's going to get remarried if you pass away. You don't want him to spend all your assets on the new family and leave nothing for your heirs. The ABC trust preserves your share of the assets for the heirs so that he can't spend it on his new family. People really like that. That's a standard part of our trust. Also, bloodline and college funding, abuse and addiction clauses are all included in our standard trust. Then, of course, the asset ledger. And then the secret sauce is at the bottom, administrative documents. We pre-prepare the settlement documents for the trust company so they can provide a very low settlement charge. Because we do so many of these, we've been able to negotiate that aggressively for you. And then we add on these other trusts. They're $1,000 each to add on. Now let me tell you about it. Special needs trust. Remember that phrase, you want your family to know you cared? Well, with the special needs trust, which protects your special needs family member from losing their state disability payment, it also includes a 600 question questionnaire about that person, their lifestyle, their family traditions, their holiday traditions, how they get up in the morning, how they go to sleep, so that their whole lifestyle can be continued with their new guardians, not just their therapies, their medicines, and their doctors. Families love that, and it shows a very, very strong care for your family. The Asset Protection Trust that Albert talked about is a revolution founded in Nevada that 18 other states have now copied. And here's why. It gives you the power to lock up your assets out of your estate, as Albert referred. But what's really exciting is you not only have access to get the earnings out of that, you've got a back door to get the principal as well. That means you've got the ability, as he said, in a self-settling trust to get that. And here's what's important about Nevada. They've already had a case go to the Supreme Court there on this, where an ex-spouse tried to get child support out of an asset protection trust, and they were turned down at the Nevada State Supreme Court. So their courts support the protection of your asset protection trust. Now, any of you with large capital gains risk are worried about the new capital gains taxes. We had a family with $1 million piece of real estate. They bought that for just $5,000. So they had a big capital gains risk. They were looking at $300,000 to $400,000 in capital gains risk on this piece of investment real estate. So we put that in a charitable remainder trust. What is a charitable remainder trust? It's something where you're going to put money for 20 years into a trust, and you're going to get money out of that for 20 years. At the end of 20 years, there's going to be at least 10% of that trust left, and that's going to go to your charity. That's the remainder. Now, here's how that works out. In this case, they put $1 million in. They are going to get $1,600,000 out of that trust over 20 years. That's going to be $1.2 million tax-free.
They see your phone.
Based on their 39% tax rate. Now, you get $1.2 million tax-free out of that. Also, instead of paying a capital gains tax, they're going to get a first-year deduction for the present value of the future gift. In other words, that future gift in this case is going to be over $500,000, $545,000. That's what's left at the end of 20 years. The present value of that's about $270,000. So instead of getting a tax bill for capital gains for $400,000, they're going to get a tax deduction for $270,000 the first year. Plus, they're going to get a payout after tax of $1.2 million over the 20 years. Wow, what a way to beat capital gains taxes. And of course, you do it in a state like Nevada. And by the way, you can change the charity throughout the 20 years. You may start with Wounded Warriors and end up with your church. Or you can split it to 10 charities if you want. You have the power to change that during your life. Now, what does all this mean? Well, let's start with a smaller estate, $600,000. Now, this is not a promise of future performance, but if you look at the 90-year average of the stock market at 5.3% growth, and I'm sure Carol or whoever your financial advisor is going to be will do better than that, but if they did that level, and the advisor got their fees, and the trust company gets their very low fees. By the way, these fees, and I'll talk about them in a minute, are significantly lower than what you'll see from most trust companies because of our volume and our negotiations. What that means is that $600,000 could pay out $24,000 a year for 60 plus years. That's $1.5 million could be paid out to your heirs. $24,000 a year for 66 years based on that return. Not a promise of future performance, but a model as to how this could work. Now, let's say your estate is a little bigger. Let's say it's a $3 million estate. Similarly, financial advisory fees, trust company fees, and of course your business, your trust is going to grow. You could pay out $150,000 a year for 37 years. over $5.5 million from your $3 million trust. Again, that's just based on 5.3% growth rate. Not a promise of future performance, but that's what a trust can do for your family. And when one of your kids gets divorced and they got a payment of $150,000 and that ex-spouse takes the 75 of that, that's all she's going to get or he's going to get. They're not going to get half of the $3 million that you would have given. Now, why are these returns so good? Because not only are our document costs at $2,000 much lower than what you'd pay to get something like this done, our settlement costs are incredibly low. In fact, they're documented in the trust. We actually put the trust company fees in our trust so that you can see them. And year after year, they're lower. Usually our trust company fees average 1.6%. That includes the fee to your financial advisor of 1% and 0.6% for the trust company. We recently took a $10 million trust from Morgan Guaranty. They were charging 2.3%. We charged 1.3% for that. That family saved $100,000 a year on the cost of their trust. That's what competition does for you in this environment. So our capability, we do both Nevada and South Dakota trust. The reason we have trust company in both states. Nevada goes for 365 years max. South Dakota actually has a perpetual trust if you want 1,000 years plus. You can do that in South Dakota. We recently had a priest who wanted to do a 250-year trust for altar boys, and we did that in Nevada. We do seamless client service through our central team. Obviously, our fees are very competitive. Our online capabilities, we do this with screen share, just like this with the clients individually. There's no charge for that. We just charge them when they're ready to do the trust and the questionnaire. No additional charges until their trust becomes active. You know, revocable living trust doesn't become active until you pass away. An asset protection trust becomes active as soon as you fund it with assets, or a charitable remainder trust becomes active. Our trust company stores the documents, and so does DocuBank online. Then the question is, who are we? As Carol said, we were brought in to consult with a trust company 10 years ago, my partner and I, and we found this big gap where there was not competition in the trust marketplace. So we brought in a top financial advisor from New Jersey, the guy who recently retired running USA Today and has a software firm in Detroit, one of the top technology investors in Chicago who's recently created and sold $2 billion companies there, and one of the top fiduciary experts in the world, Wayne Miller, who consults with the Fed and governments all over the world on fiduciary responsibilities. All of them are on our board and investors in our company. That's what we do. I'll be happy to take any questions.
Well, can you show that a part of that, just a quick showing of the document that you have? I know some of them are curious to see what part of the document looks like. It really is just a contract.
Okay, here's a trust, the sample trust we do. And can you see this, Carol?
Yep.
Right on the front, it says Nevada Situs. It says that here's this Nevada law that validates our trust. And all through this is the reason trust companies like our documents. And the lawyers in Nevada and South Dakota, we name the law all the way through. We get paid up front, and we get compensated on the back end by the trust company. That's the reason we can do it so affordably. Not only do we drop the prices on the back end, we got the trust companies to give us a little bit of their fee. So that works all in your favor. Now, I'm going to go to the part of the trust where all the change is made on a marital trust. This is an ABC marital trust in Nevada, Article 8. Starts with a charity as name.
Steve, by ABC, is that an acronym?
Yeah, no, ABC is the marital trust that creates the trust when the first spouse dies. It creates the B trust that preserves her assets for her heirs so that the surviving spouse doesn't spend it all before he dies or she dies, and that there's something left for the heirs. So the B trust is for the deceased spouse. The A trust is for the surviving spouse. The C trust is actually a Q-tip, which is a trust designed to help the family avoid taxation if they're above the federal threshold. So That's the standard trust, and that's what most people want because it protects the assets for their heirs in case the surviving spouse gets remarried. Okay? Now, the charities are named first. I did one yesterday that had about 10 charities listed. Then the heirs are listed. They can be equally or unequally. Doesn't matter. It's all customized. And then I'm going to go to some of the specific directives that people really like. Beneficiary debt forgiveness. You know, I always tell people that your children are perfect, but they marry imperfect children. And usually the problems that come up in an estate are from the in-laws who say, hey, your brother went to a more expensive school than you did. He should put the difference in the trust. Well, there's not a legal reason for them to do that, but to prevent arguments like that coming up, we like to put the beneficiary debt forgiveness clause in. So there's no implied debt. Today, sadly, a lot of people want a substance abuse and addiction clause because the trust might last through their grandchildren, and they don't want them getting a check every quarter if they've got an addiction. So we put that clause in if they want it, and that gives them 2 times to get clean. The trust would send them to a rehab institution and give them a chance to get clean before they start getting checks. A lot of people want to put a college funding clause in. Again, this is all in our standard trust. Nothing is extra here. College funding, a lot of people now like to do it as a loan because some people will go to a 4-year, a 2-year, or a trade school. And that way, if they pay it back after they get out, not by writing a check to the trust, but they'll just get less out of the trust going into the future so that it keeps it all equal. Generational holding trust. This is what most people want. And that pays out a set percent or a set amount for generations. If you pay out 5% of the trust each year to your heirs, it might last 40 to 50 years. You do 4%, it might last 60 to 70 years. If you do 3%, probably last 365 years. You do 10%, it might last 12 to 14 years. Depends on how good a job Carol or your investment advisor does in the trust. And as Albert mentioned, these are directed trusts, which means your investment is done by your financial advisor, and the trust company does the administration work, and they charge a 0.6% for that. Business continuation language. Here's where your investment advisor is named. Unsuccessful contest. Bloodline. Here's what people like. You can do a letter to the heirs. Every time they get a check, they get a letter from you, maybe with your picture and a halo over it, saying, I'm watching you. Be good. People really like that. And of course, being cremated and buried, the trust says that they'll pay for your burial. And then who are your successor trustees? Dunham Trust Company, investment advisor, trust protector if you want one of those, any ex-spouses or people that are disinherited. And then I'm going to take you to the back of the trust and show you the fees. Here's where we show full disclosure that the trust company fees are listed and signed off on. So if the trust company does the investment, let's say on the first $1 million, they're going to charge 1%, and then it's going to drop every $1 million after that. Then if they do the administration as well, it's 6.5, so they're going to charge 1.65. But if your advisor does the work, then the trust company is only going to do the administration for 60 basis points, or your advisor charges 1%, trust company charges 60 basis, so 1.6% would be your charge to the trust company from the trust after you pass away. That's an incredibly affordable and low price. I've talked to people all over the country, and they haven't seen prices like that for trust costs. And for settlement, besides the first year fee, they add $500. So that's an amazing, and that's all signed off on by the client right here. So if they see these fees in the trust, we believe in transparency because we know they're the best prices out there. And it's also with the trust company that does this for billions of dollars worth of assets. Does that help, Carol?
Yes, absolutely. That's great. So, all right, you can exit your screen sharing so we can bring back Albert before he goes to the next call. And there you are. Thank you. And at this point, if you have other questions, feel free to ask. And of course, I'm going to start with this question. Oh, but on the side note, Steve talked about the investment. So as you can see, there's really nothing changed except that you're moving into the trust. I will still be advising you the way we're doing right now. We move the funds that you feel most comfortable where you make money, and we move in and out of the funds exactly the way we've been doing right now. But you might have other questions, and I request that you bring up the questions right now. And let me start with one. One of the favorite questions about Medicare planning. So, Albert, I know in the state of New York, a lot of people are seeking lawyers who could help them with this. And the fact is, many of my clients are really way above, the Medicaid requirements, and they have also their qualified accounts, their qualified IRAs. So, who do you think could qualify in a Medicaid planning at this point? Because I know a lot of clients are going to lawyers for this. Who would you recommend, or who will qualify? Let's put it that way.
Well, one strategy that a person who's planning for Medicaid can do is create what's called a Medicaid Asset Protection Trust, where the biggest asset that you generally want to shield from New York Medicaid is the house. So you could transfer the house. The house is usually not income producing, so getting back income from the house is not usually an issue, because the beneficiary in that case couldn't be the grantor as far as income is concerned, but could retain a life estate. So New York Medicaid can't attach a claim to a life estate, and so the idea would be to transfer the house to a Medicaid Asset Protection Trust, and if it goes through the 5-year period, it's going to escape the Medicaid lien. If it doesn't, a nice benefit to doing this is that it'll avoid probate. And like Steve said, that that probate is something you want to avoid, and have those assets passed directly to your beneficiaries.
And Steve, anything to add about that?
Yeah, I'll tell you, we used to sell a lot of Medicaid qualifying trusts, and we still will sell them. But honestly, most of the people that are worried about that might be on the lower end of the estate size. And our first recommendation to them is if they've got a happy family, try to move the deed into the name of someone in the family. And the reason that we say that is, there used to be a 3-year look back. Now it's a 5-year look back. There's a lot of talk about it going to a 7-year look back. They're going to keep extending that because the government needs to get their money from Medicaid. And that means you're going to be paying trust fees for all those years on that trust. And our goal is not to get people to pay more. We're going to try to give you the cheapest way to get there. If your family is a family where you trust the kids, that you can get them named on the deed. And of course, that deed's going to have to be done 5 years before you end up running out of money in Medicaid, because the look back applies. But it didn't cost you anything but the $50 to change the deed in the county courthouse if they don't hit you with a capital gains tax. So, you guys are CPAs, you can help look that scenario over, because I always say to people, look, the best defense is to have a house with a bedroom and a bathroom on the first floor, to make sure you can bring help to you when you're getting older. Your quality of life's going to be better, your costs are going to be lower, and you didn't pay us a dime to do the trust, and you don't have any trust fees. So we default to save the client, and then if they don't have that situation and they want to do it, we'll sell them the Medicaid qualifying trust. But it's there, it's an available product, but you got to start the clock at 5 years once you put the asset in the trust.
Just wanted to add one thing. I personally, I've never seen a trust I liked, and that's because there's so many contingencies. that can arise, and but there, I do see that the use for them, and one good thing about using the Medicaid Asset Protection Trust is that you won't lose, if the trust is done right, you won't lose your exclusion for capital gain on the sale of the house. Well, if you transfer that to a family member, you wouldn't. The family member would have to live in the house for 2 out of 5 years, and also own the house for 2 out of 5 years, to get that exclusion under Section 121.
Oh, now this is you're talking about house, the property. What if the client has a very substantial qualified asset like an IRA, and usually they come in the ballpark figure of about $600 to $1 million IRA? Is I don't think they would be qualified, right?
Well, that you couldn't put into a trust, a qualified plan, but this might change from state to state. But usually, if the person's receiving RMDs, then the plan is protected from Medicaid.
Oh, the RMD itself. But in I think in calculating Medicaid, you look at the amounts of the IRA. Let's say it's $1 million. So now you're talking of $1 million in assets.
If they're receiving RMDs, I believe I believe that it's exempt, that the plan is exempt. The fund, the total amount is exempt.
Oh, all right. That's great. So we have here some nonprofit. If you have any question, Joel, go ahead. And we have somebody who also is from California. So go ahead and ask your questions, if any. Let me see who else is in the group. Okay. So like I said, this is recorded, and part of this we're going to edit. We're going to edit out the portions of the lectures so we can replay it at a later time. Now, okay, Miss Lani all the way from the Philippines. Oh, the other thing that my clients would ask, they have properties outside the jurisdiction of the USA. That is something, can we include part of it, or can we make a reference in the trust documents?
Yes, you can. That might be a victim of out-of-state, out-of-country tax impact, but certainly we've done trusts where the out-of-country real estate is and properties are listed.
Right. And you would have to, you would need to have counsel in the other country just to see what's involved in transferring assets. I recently had a client in India, and they had a business when we were going through their organizational chart, and there's some types of entities in India that can't be transferred to another entity. It has to be owned by a person. But if you did it under your will, usually the other country would respect a will from the U.S. as long as it was executed properly. But it's a good idea to execute another will, or if possible. I know this is especially in the Philippines. If you own property in the Philippines, it might not be feasible to set up like what we do here in the U.S. is if you own like a house in Florida, you would set up a revocable trust in Florida to own that property, so that way you can avoid probate in Florida and in New York. But you couldn't do that in the Philippines. Apparently, it's you couldn't transfer property to a revocable trust equivalent in the Philippines and have it pass to your heirs in the U.S.
So as one final question for me, you mentioned about the will. So how do these things work together? So initially we talk about the trust, but as part of the basic estate planning documents, you also have a will. Can you quickly go over these important documents? How about you, Albert, first?
I would love to. Unfortunately, I do have the hard stop, but I think Steve covered that pretty well.
Oh,
Yeah. So I apologize that we're up.
oh yeah, it's already.
But Carol, I want to thank you very much for having me speak today. And Steve, it was a pleasure speaking with you, and I'm very grateful to have met you too. And I'm sure I'll be in contact with you in the future.
Albert.
All right. Thank you, Carol.
All right, thanks, Albert. I'll be in touch with you. Some of my friends will be in touch with you as well. So, yeah, Steve. Yeah, you mentioned something about the wheels. So let's just align it quickly. Okay, so you have a trust, and I know there are other basic estate planning documents. You still need a will, although that goes in public.
Yeah, the will that is included with the trust. Let's say the basic trust you're going to have is
okay.
The revocable living trust. So that's your basic platform. And that is a trust that gives you power to make changes. Now, you might add the other trust, the asset protection trust or the charitable remainder trust, but your basic trust is your revocable living trust. Now, you're going to put your assets in one of those trusts. If you forgot an asset, if you got an asset like an old credit union account or a piece of property you forgot about or a bank account you forgot to list, that's going to end up going into probate court. And probate court's going to look around and they're going to say, where's the will for this? Because they recognize these wills to probate an estate. And so we include what's called a pour over will. It's a will that's very simple, and it says to probate court, pour over any missed assets into the trust. It's a safety net. It catches assets left out of the trust, and there's always one or two small assets left out. It might be a car. It might be, something that changed and you didn't change it in the trust. That's okay, and the court does it very quickly, and it's usually a small asset item.
So it doesn't. In that case, there's really no need for that separate will where you have to mention again those other assets because obviously the assets are already in the trust. So that makes it really simple. So whatever assets are not covered by the trust will be covered by the pour over will, which is a very simple statement in the will.
Right.
That makes a lot of sense. Now the rest of the documents, is that part of your the healthcare process and all of that? Not
All
really.
part of the package. And the package includes, for $1,950, the trust, the pour over will, the asset ledger, the healthcare proxy, the financial power of attorney, and 5 years of an emergency medical card. So when you go into a hospital, that card can be in your wallet next to your healthcare insurance card, and they can call and get your advanced medical directives sent to the hospital. People really love that. So, you're getting a real complete portfolio. There's nothing extra for you to buy for most families. 85% of our clients, that's all they need for $1,950. It gets it all done.
All right, I think you pretty much covered everything. Just a reminder, today and tomorrow to celebrate the Labor Day, on your chat room over there, there's a link to the free download of my ebook. All of you already have copy. And this is the companion to the printed edition that I gave you. So wherever you are, you can just quickly go to chapter 7 and chapter 8. And this is something that would concern us at this point in our lives. And I have some stress testing techniques there of your financial plan. So, Steve, we are very appreciative of you joining us today. Unless anybody else have a question, and all the way from the Philippines, my friend there, Lani, thank you. It's early in the morning, and you are on mute. You can unmute yourself right now. And Joel, I would love to meet again with the Pilgrim Church very soon. And my friends, Penny, Denise, and Denise, I haven't seen you in a long time. So, friends, do you have any more questions? If not, I'm going to give you the contact number of Steve anytime you need it. So just text me and we'll have Steve. And if you want to meet Steve one-on-one in a Zoom meeting like this, yep, absolutely, we can do so.
Look forward to it.
Yeah, yes. And yeah, that's it. All right. Thank you once again. And we're ready to sign off. I guess there's no immediate question right now, but feel free and think about this. Feel free to send back the questions as they come to mind. And I'm going to send it to Steve. And if you want a private session, Lani, when you come back here in New York, if you want a private session, Steve, at the Eastern time, then we can do so. All right?
All right. Thank you so much.
Great to be here.
Thank you, everyone. And we'll see you soon again in another session. Bye now.
Bye.